Rich, where are we in the commercial real estate cycle? We see a lot of people, especially in New York City, returning to the office. What does that mean for those big buildings out there?
So the short answer is that we think the worst is behind the commercial real estate cycle. Over the past 2.5 years, commercial real estate valuations are down more than 20%. But over the past 4 quarters, we've seen an inflection where total returns are moving positive. That's driven almost entirely by income returns, as price returns are going to be muted over the next 12 months or so. But that's good enough given how out of favor the commercial real estate asset class has been.
Well, as an investor, do you want to own the debt or the equity? REITs, I don't know. How do you want to own this comeback?
Yeah, at Principal Asset Management, we take a 4-quadrant approach to investing: public versus private and equity versus debt. Across the 4 quadrants that we look at right now, we really like private commercial real estate debt. It offers very attractive risk-adjusted returns, and what we think is undervalued is the stability of those returns.
Can you talk more about the structural trends helping real estate? Because quite frankly, investors are just looking at big cap tech stocks right now. They're not really putting real estate on their screens.
Yeah, sure. So we think there's 2 things that investors need to focus on. First of all, income returns are very important for commercial real estate. Income returns are around 4 to 5% on a per annum basis. It's almost like a bond, if you will. But the second thing that investors have forgotten about is commercial real estate has an equity-like component to it. And it does offer appreciation returns over the long term. So we think returns are going to be around 5% in 2025, but they're going to rise to around 7% on an annualized basis over the next 5 years, and probably closer to 8 to 9% over the next 10 years.
And which types of commercial real estate do you favor? Do you like the strip malls? Do you like the Class A in the big cities? What do you like?
Yeah, sure. So when people think about commercial real estate, they usually think about it as a singular asset class. But in reality, it's 18 different property types under a broad umbrella. It's become a next generation asset class. It's not my grandparents' asset class anymore. We like things like seniors housing and data centers and single family rentals. These are asset classes that didn't exist 10 years ago that are now really important parts of the commercial real estate sector and growing quite fast.
All right, my next question has 3 parts. Location, location, location. Where's the best place to buy it?
So I'm going to push back on the location, maybe in not the way you're expecting. We do think that we're going back to a back to basics investment philosophy where you're finding the right property types in the right markets. There are opportunities across the United States right now, whether you're looking at office properties in the Sun Belt, whether you're looking at apartment buildings in the Midwest, whether you're looking at maybe apartments on the West Coast as well. There's opportunities everywhere. What we're really focused on is a bottoms-up investment philosophy where we're targeting the best net operating income growth, regardless of where the property is and where the market is.
And then finally, how will the idea of lower rates, if we in fact do get them from the Federal Reserve, hurt or help the real estate sector? One would think it would help because you're paying dividends and steady cash flows in the real estate sector, and interest rates are going to be going down from the government.
Yeah, we're not betting on them going down. It's not part of our investment thesis. We believe that that interest rates, long-term 10-year treasury rates, are going to be range-bound in this 4% range over the medium to long term. What I caution investors is when you think about interest rates going back down to 3.5% on a 10-year basis, that might not be for such good reasons. It could be because of a recession. Recessions aren't necessarily good for commercial real estate, and you could see credit spreads blowing out. So we're not cheering for a lower interest rate environment. If we got one because of a soft landing, that would be a huge home run. But that seems like you're threading a needle there.
All right, well, thanks a lot for coming on and talking about it.
Thanks for having me on. Take care.